Hi, Richard Martin here from the Market Forecaster, and showing you a weekly chart of the ASX 200 through the SPY. And you can see that this week we've had a pretty bearish week on the strength of very poor numbers coming out of the US, significantly lower housing sales, and a range of other manufacturing data, which has pushed the broader indices all down, which is in line with our bearish view. On the daily chart, this is the ASX 200, and you can see that we hit our target of 4258 right on the head, and then it's retraced very significantly back up, which in fact is a bit of a bullish candle on the daily chart. My one concern out of this pattern is that this looks very ABC, in other words, a correction to this particular correction that tracked up. So my concern suggests that we should look very carefully at the stops and ensure that we're trailing down, and that in fact the logical stop I think is at around 4372, which is just above the previous day's high. And I think that we may see further resistance along this line, and in fact if I went to a 240-minute chart and put a trend line on, this is the other way that you can actually manage the stop, which looks actually more like this. So you can see the piercing candle pattern here with the low on the 4-hourly chart against the 4,258 target that we set, which was a Fibonacci extension against this run down and this run up. The possibility there, if you set your targets, was to take some off the table, 50% off the table, or indeed you can let it run. And my view is that we've got another leg down in this. This should be in fact coming up for a fourth wave here. So this fourth wave is quite likely to run back up to 4359. The stop again can be over the top here at 4441 or 4418. I think we moved our stop down to break even. What I'd be very keen to do is see this track up and then roll over, and immediately we lower our stop. But yeah, I think it looks like it's got another, this pattern should unfold into a fourth wave, and that would see another low, which would include the Aussie dollar low. It would include the Dow, of course, and those major indices, the FTSE included. Just looking down at the MACD, you know, it has tracked down very nicely, but we are seeing a slight crossover happening here, so we definitely would expect some upside action on this chart. Just showing you the continuing weekly chart of the Dow, which is the head and shoulders pattern. You can see how it continues to break down. On the daily chart, a little reversal candle here, short-term reversal. Again, we could run a trend line down, and the stops effectively sit over the top of this trend line, and that figure of 10,313, this is on the E-mini futures, so you need to check this against your individual charts and market maker platform, because these numbers can differ by up to 40 odd points. What's pushing this down is again the poor housing information data that's coming out of the States. It looks very, very bleak, and of course most of the major banks throughout the US are all reliant on solid or increases of any sort on commercial and residential property. This is simply not happening at this point, so therefore we would expect this to track back up in an ABC correction, and then hit this support line or thereabouts, and then continue down in what could well be a fifth wave. So down for 1, up for 2, we're doing 3, up for 4, and then down for 5. And in fact I can quickly set a target on that, which we've done before, but you can see that this is the 1 for 1. So this 1 here means that this leg here has to this low here has been now equated here, and so that's the run down from this top to this bottom. Measures exactly the same as this top to this bottom. So the point here is that if this was an A, B, C correction, then we would be breaking this line and making new highs, and hence the importance of having the stop just above here, or indeed you can trail it down slightly. So if it looks like breaking out, but be careful because you can see these long wicks here, they can often poke through, suck back, and then continue on their way down. So you don't want to have the stop too close to the line here. But nevertheless, you know, it's a little bit of a knife edge at the moment because of this ABC pattern. The potential is for it to be a B wave, which would mean a C wave up for the further correction. Sorry, that's a bit high up there, but certainly a correction which would look to taking out the 10,675 odd high if that occurs. But at this point, the data and everything else, including the volume, as you can see the volume rising down here, suggests that we've got some more downside to go. Moving on to the weekly chart of gold, you can see that this has been a very significant move up, but it is an ABC. But there's the support line, and indeed, you know, if we were being very conservative from a long-term perspective, you would wait for that line on the weekly to be broken before going short. However, if we look at the daily, indeed, this is the ABC. It's now at the upper reaches of the mark. It's trading at 1239, I think 1247. Which is an extension on my previous forecast of 1337, but we're right at that now. Having said that, it hasn't really broken through. So just going back to the 4-hour chart, you can see that this is an ABC followed by an ABC. So this is the correction that at the end of this 5-wave pattern that's come up here. 5-wave pattern finishes here and then comes back in 3 for a correction. We entered. Looked like a good thing. Certainly we were in the money there for a while, but then it broke down. We set the stop just above here, and of course this, which I think is a B wave, has taken out that high, which is very frustrating. That said, we'll be looking to re-enter this trade in the event that we get confirmation. The stochastic here rolling over and breaking down across this 80 for a cross, an entry. We will do the same thing, otherwise we'll be just giving that money that we lost on the stop back. Now, important also to, on any of these stops, when we enter these types of trades, and of course it's very volatile at the moment, is that we really take care because of our equity. So I would stress that these would be a 1% of equity entry. Ensure the stops, if they're going to be far apart as this one was, we entered at 12.15, our stop was at 12.39, that we really reduce the position size to cater for the risk that's associated. So 1% of the equity in your account is generally the way to go.